With this, I would like to open the floor for the questions. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question.
The conference is now being recorded.
For a moment while the question queue assembles. A reminder to all participants present in this conference, if you wish to ask a question, please press star then one on your touchtone telephone. The first question is from the line of Faisal Hawa from H.G. Company. Please go ahead.
Hi. Hello.
Yes, Faisal, we can hear you. Go ahead.
Is there any chance that most of our contracts which are now being signed with the MNCs are at a fixed ROE basis, and the prices are fixed in such a manner that we are earning a fixed ROE? Is there a chance that going forward that we would be in a better negotiating position, that we would be able to negotiate better ROEs, or we could have contracts in which this ROE system is also eliminated, and where probably we may have to take a bit of more risk, but our returns could increase and our EBITDA margins in turn could also increase?
Sure. So this is Samir, and I'll take this question. In terms of, so Faisal, while you seem to be well aware of the working of the company and all that, for the benefit of everyone else, let me just spend 30 seconds on trying to explain your question, because I'm sure your question may not be as clear to everyone else. So HFL basically has three business models. It has a business model where we set up dedicated factories for our principals. These dedicated factories are long-term contracts which have a take-or-pay kind of a contract with our principals. The second business model that we do is shared facilities. In this case, we manufacture competing products for competing principals within the same factory, where, however, the principals do not give us any guarantee in terms of volumes or of the tenure of the contract. And the third business model that we do is private labeling, where we help retailers and or digital e-commerce brands set up new products. We help them with R&D, we help them with packaging development, and we launch the product with them, while the brand is completely owned by the retailer or by the e-commerce player. Now, coming to Faisal's question about the ROE, within these three business models, the first business model is where we take on the least amount of risk, since it is a guaranteed contract. And obviously, that's the one where Faisal was talking about the fact that whether we will be able to increase our ROEs going ahead. In case of Faisal, all of these contracts, the ROEs are fixed for the next 10 to 15 years. Let's say 10 to 12 years, between 5 and 12 years. So as a result, since these are long-term contracts, for any project that we've set up, we have complete visibility of what the earnings from that project will be for the next 5 to 10 years. And neither of the contracting parties have the privilege to renegotiate the terms during the tenure of the contract. However, in case of the shared facilities and in case of the private labeling facilities, yes, there's a huge amount of operating leverage that we can achieve, and the ROE in both those businesses can be substantially higher. Not to say the ROE will be, of course, linked with the risk. So in the first business model, since we take the least amount of risk, we get ROEs which is proportionate to that. In case of shared facilities, we take on a little bit higher risk. The ROEs are higher to reflect that. And of course, in case of the private labeling, we take on the max risk and the ROEs reflect that there. So going ahead, as a change of the business mix changes going ahead, that will change our ROE as well. But within a particular subsection of the business, I don't see ROEs changing drastically in the future.
So just as a follow-up question, how much of our business or our revenue is on this fixed ROE model, and how much is the rest?
Currently, Mayank, correct me if I'm wrong, but currently we would be at around 80-85% would be fixed, and the balance would be contract manufacturing and private label.
Thank you very much. That answers my question.
Ballpark number around 80% will be the...
No, perfectly okay.
Yeah.
Yeah, perfectly okay. Yeah.
Thank you. Before we take the next question, a reminder to the participants, please limit your question to 2 per participant. You may come back in the question queue if you have a follow-up. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Good evening, sir, and thanks for taking my question. Sir, a related question to what the previous participant was asking. So in this fixed...
Sir, I'm so sorry to interrupt. May I please request you to speak a bit louder, sir?
Yeah. So in the fixed ROE business, what is the pre-tax ROE that we are contracting in general?
Sorry, Sarvesh, this is a competitive and the confidential information which we cannot share because we are bound by the confidentiality agreement with our customers.
No, but for the overall business model, is it into? Are we talking about high teens or what?
Our long term, if you need a ballpark number, our ROE ranges between 16 to 22% pre-tax.
Pre-tax. So then I was not able to triangulate that number with the 30% ROCE which you have mentioned on one of the slides, slide number 5, because you said 85% of your business is in this model.
Sure. Mayank, shall I take that?
Yeah.
Okay. So Sarvesh, what you're seeing right now is a company which is in the middle of a major transition and a capex investment. So if the 80-85% that we talked about is the number going ahead, if you looked at our numbers last year, probably the number would have been different completely. There would be a larger scale, a larger share of shared facilities business coming in. And also you have to look at the fact that in terms of our various projects, they are in various states of implementation. Some of them have gotten implemented and started production. Some of them are in the process of ramping up, and they will achieve their scale in the next 5 to 6 months. And some of them are just being built. So I would say, while what Mayank has told you is a figure which is steady state, you will see aberrations for the next 2 or 3 years, especially since we are growing as well as investing at a completely disproportionate rate.
Understood, sir. And this number of around the vision of 2,000 odd crore revenue figure, do we already have the visibility in terms of talks in the pipeline and everything, or is it an aspirational number? So I mean, I want to know how certain we are about the sort of the guidance for the coming years in 2022.
Yeah, again, I think this question is directed to me because I am the one who's been talking about this number in various forums that I can, including having put it in the annual report and the investor presentation. So Sarvesh, yes, we have a decent visibility of the path ahead. Of course, it's a little bit of a stretch target, especially because of COVID and because of the happenings in the last few months. But we are, as of now, very confident that we should be able to get there.
Understood. And finally, one question which I had was, given that in your business, I mean, in general for FMCG sort of manufacturing, it's not very capital intensive in a sense that if one were to put up the new capacity, it's not going to cost you a bomb. So what is working for you in terms of getting these new sort of contracts which is helping you scale up fast? Because I guess a lot of people can or will be able to manufacture this because the capital requirements are not that taxing.
Okay, good. Sarvesh, so couple of things and I might take a couple of minutes extra on this. So Sarvesh, couple of things. One is the barrier to entry. For one, when you say not cost a bomb, it's a relative word. We are investing, we've invested close to 300 crores in the last 2 years. We have already announced plans to invest another 150 crores in the next 12 months. We have plans to invest further. Now, whether this is large enough to be a deterrent for other people or not, it's not for me to say. Obviously, there are a lot more players who are well funded and have the wherewithal to invest a lot more money than this. And then there are many players who do not have the wherewithal to be able to fund this or even think about executing projects like this. However, one thing which is very clear, Sarvesh, our competitive advantage is not the fact that there is a amount of capital, large or small, which needs to be invested in the factory. Our competitive advantage is basically the execution. You don't go to a Foxconn because Foxconn has got more money than Apple to invest in an Apple factory. You go to a Foxconn because it has better execution skills in being able to manufacture phones, while Apple can then concentrate its skills on marketing. And that's exactly what it is. So I would urge you to look at the contract manufacturing industry not as just a pure investment in infrastructure. You have to look at it as investment in execution skills.
Yeah,
I'm happy to discuss this at length. And if frankly there are no more questions at the end of this, we can just circle back to this if you want, or I can take it offline later.
Sure. Thank you, and all the best for the coming quarters.
And also, Sarvesh, it is all about the relationship with the customers over the years, which is built over the years, and the trust we build because we are dealing with their product. It is their brand which is at risk. If the contract manufacturer is screwed up, the brand gets impacted.
Understood.
Yeah, so
thank you.
as you can see, the entire management team is very, very passionate about this question, Sarvesh. Happy to take it back if we have time at the end of the session, or if you can write to us, I can send you a 2-pager on this entire thesis of why all of us are putting our money where our mouth is, as far as contract manufacturing is concerned.
Sure. Thank you.
Thank you. The next question is from the line of Pankaj Popre from Axis Securities. Please go ahead.
So what is the current capacity of ours, our capacity utilization? And going forward, as you mentioned that you are going to invest, what would be the peak potential revenue from the expanded capacity? So would we be able to meet the 2,000 crores goal with the current capacity, or we need to invest more? And second thing, what is the tentative timeline for us for that 2,000 crores goal which we have aimed for?
Sure. Pankaj, again, I think I will take this question for the specifics on the numbers. Mine can pipe in. But in terms of our current capacities, which have already been implemented and are running, we are at the run rate of around 1,200 to 1,500 crores, which you would have seen from our previous quarters' figures. In case of the 2,000 crores, the timeline that we put to ourselves is FY22. And this investment that we have, the board has already authorized, will help us get to that figure.
You mean the additional 150 crores, right?
Correct.
Okay, sure. Thank you, sir, and good luck.
Thank you. The next question is from the line of Vineet Rai from JM Financial. Please go ahead.
Hi, this is Vineet here. Thank you for taking my question. Hello, can you hear me?
Yes, Vineet, we can hear you.
Yeah, I had 2 or 3 questions, and you decide how many you can take. So first of all, what is the sector-wise split of your business currently, or once it gets to 2,000 crores? I mean, how do you see the split within the sector?
So we are actually quite agnostic about the sector as long as it is an FMCG. So within the foods, personal care, home care, as well as household pesticides, insecticides, we are quite agnostic about what we do. So this is why in my opening remarks I said we manufacture something like Mortein which is a pest control product, and we also manufacture Farex, which is an infant food formula. The business model and our structuring of the entire transaction remains similar across the product categories. So from that perspective, frankly, we are quite agnostic about product categories, and we don't look at it that way at all.
No, appreciate that, but I mean, of course, you guys are the experts, but I had, once you kind of, and these are, typically repeat businesses, right? Once you take a Mortein or a whatever, water products, these are, since this is the consumer sector, once you block a machine with, and of course, I don't know your processes so deep enough, but once you kind of block certain machine hours, my guess is that those machine hours would be utilized for the same category of client or product, etc., or is it very fungible? Is that what I'm hearing from you?
Okay, so two things. One is, let me first tell you that when we look at a dedicated facility, if you're tied up for a product, then that is a long-term contract which is good for the next 5 to 10 years. So as a result, that facility is not fungible at all. So if you set up a facility which is manufacturing, let's say, home care products, and it's a long-term contract for the next 10 years, it's going to be manufacturing home care products. From a consumer perspective and from your own academic interest perspective, let me tell you that machines for most of the products are surprisingly fungible. So, for example, even in case of a home care product which manufactures, let's say, liquid detergent, you could technically end up making hand washes and, let's say, personal care products like shampoo, etc. The one example that I like to give to my family is that the same machine which manufactures infant food can also manufacture a snack food like kurkure. So it's a little incongruous to think about it that way, but unfortunately, FMCG, we are not dealing with rocket science. The capacities are fungible to a certain extent, but within the construct of our contracts, they are not fungible at all for at least 5 to 10 years.
Sure. So if there is a way for me to understand it, since you said at the opening that 80% of your business is anyways dedicated line, so that the sectoral breakup there would kind of tell us, right, how the sector split is.
Oh, yeah. Okay. Mayank, do you have that number? I don't have that number.
Or even broadly, which is the leading one? I mean, is it personal care? Which are the top two, leading ones within your category?
The top two would be home and personal care and foods. I mean, there are only 3, right? So, if I tell you the name of food, then because there's home and personal care, which we constitute as one.
Sure. Okay.
There's food and beverages, which we constitute as one.
Right. Okay. Fine.
Right.
So those are the two.
Yeah.
Okay.
So
and personal care will be around 40%.
40%. Okay, got it. And typically, what is the wallet share that you target, within a certain SKU from your, customers?
Target? We would like to target 100%.
No, so that's not possible. Like in packaging, we see generally, nobody can cross 45 or 50. So that's why I was wondering how is it for you guys?
I was just being flippant. Your question is very serious. I was just trying to make a joke. The product in case of the manufacturing, frankly, the target or the wallet size depends on the product itself. There are certain products which do not have a scale which requires multiple factories, and in which case the company might be okay to have a single manufacturer for it. And they might have a small, what is in our terminology called a BCP, business continuity plant, just to ensure that in case there's some problem. However, there are certain product categories which are very large and saturated the market completely in India, and in which case you would require multiple factories. In that case, the wallet share could again vary from as little as 10 to 15% to as high as 50-60%, depending on the number of factories there are. To give you some examples, if you take a product like detergent powder is such a saturated market, and the quantity required in the whole country is so high that if you have to get to let's say 20-25% of the detergent market in the country in terms of wallet share, you would have to set up Garangutan factories across the country.
No. So maybe the better way to look at it is, and of course these are very long discussions, but very quickly support certain maybe because transportation also could be something, because from one plant to some. So wherever you are kind of, supplying, say, a detergent to, for, lack of a better example, say, Ariel, say, which is 200 kilometers away from you or whatever, at least that plant-to-plant market share, wallet share would be in excess of 50% or would be like 20%. That is also helpful.
If it is a transport optimized plant, then the wallet share will be 100%.
Oh, is it? Oh, interesting.
Nobody would like to lose money on the transportation.
No. So what you're saying is that there is not much competition within that catchment for you. Is what I'm hearing.
No, absolutely not. You can't afford to do that.
Okay.
Because then you become subscale. I mean, while Sarvesh was talking about the fact that it doesn't require a lot of capital to set up a factory, it does require a lot of execution. So
right.
You don't want to set up 300 crore facilities within a distance of 200 kilometers of each other and have them supplying.
No, you wouldn't, but your competition could. That was my real question.
From a principal's perspective,
right.
The principal has two factories of that size.
Right.
He's going to have to cater to that much market. He would much rather move that other factory 500 or 1,000 kilometers away from this one and cater to that other catchment area.
Got it. Understood. Can I take one last question? I know they will push me out of the queue, but one last one.
Sure, Vinny, because I have no visibility on how many questions are there. So I would hate to not be able to answer the question and then find out that we have nothing to do for the next 10 minutes.
No, just one last one. So, okay, otherwise then I'll come back any which way. So, can you give me an example where you really, added some, value to your clients? One is, you just do what the client tells you to do. But, can you give me an example anywhere where you really done something together with the client and come up with something, which really the client appreciated?
We hope the client appreciates everything we do. But
I mean something innovative, something, where you could actually maybe reduce its cost or something like that.
Okay, so our entire private label division actually works on exactly that premise. So you have private label e-commerce portals, the large portals in the country, who would approach us and say that this is the largest selling product on our website, and can you make something similar for us? And so far we've been able to meet that requirement, and I'm happy to say that some of our products in the private label division are now one of the largest sellers on their e-commerce portals. That's as far as the private label division is concerned. As far as shared facilities is concerned, we have been able to deal successfully with very, very seasonal products like glucose powders and prickly heat powders, which require production only in 3 to 4 months in a year. And we've been able to service demand for the last 10 to 15 years without having any problems, both in an economic way as well as from an operational way, by ensuring that our factories are manufacturing some other counter-cyclical products as well. And I'm sure all of our customers appreciate the fact that when they need the product and they need to not maintain a facility for 8 months as empty just to get the product in 4 months, I think that's a big service that we deliver. In case of dedicated facilities as well, we've actually taken over facilities from our principals and have managed to, if I may say so, run them more efficiently.
Understood. Got it. Thank you. I'll come back in the queue.
Sure.
Thank you. The next question is from the line of Prateek Podar from ABC and Associate. Please go ahead.
Yeah, hi. So I just wanted to ask you 2 questions. One is just the journey beyond 2,000 crores, right? Because I think you're fairly there in terms of this 2,000 if you annualize, plus add the 2 businesses which you are going to merge. So I want to ask you, beyond 2,000, how should we think about growth? Is it more from clients insourcing to outsourcing or incremental production being outsourced to you? How should we think about this?
Sorry, that was Prateek, yeah?
Yeah, that's correct.
Okay, Prateek, actually, so first of all, thank you very much for saying that the 2,000 is in the bag. I hope my board of directors is also listening to it and they also give the same vote of confidence. But you're right that we have a decent clear visibility as far as the 2,000 is concerned. As far as the growth beyond 2000 is concerned, frankly, I am far more bullish about the growth beyond 2000 than I am of the 2000 itself. And that's for both the reasons that you mentioned. One is because of the strategic and the structural changes happening in the economy and happening in the supply chain of FMCG. We believe that there will be a larger share of production being shipped out, which means insourcing to outsourcing. And that's going to help tremendously in terms of us getting new opportunities. COVID has frankly precipitated that process. COVID has exposed how the supply chain in the country is fragile, how certain lockdowns affected the availability of the product for the customers, etc. And it has led to an impetus in terms of decentralization of manufacturing. The second part of yours is about the organic growth in FMCG. And the fact of the matter is, I think all of us know about the consumption story. It's been repeated too many times. If the FMCG consumption in the country with a population of 1.6 billion people keeps increasing at 5 to 6%, we do not have the headroom in our capacity to be able to deal with that. And when I say our, I mean not Hindustan Foods, I mean the entire industry. So the demand for new capacities will continue to be there as long as we continue to grow like this. And any one of us who's been abroad and who's seen the kind of FMCG products, the variety which is available outside versus what is available in India, I think we still have a long way to go in terms of growth in the consumption, especially both for capital as well as in terms of choices for that individual.
And I just wanted to check globally also this model of outsourcing is extremely prevalent. I'm not aware, but is it that these FMCG majors are now started, or they traditionally, because over there these issues of supply chain, GST, etc. won't be there that much. So globally also these guys used to outsource only traditionally?
So in fact, globally, GST was already there. So in fact, for us, GST is not a problem. GST is a welcome step for the contract manufacturing industry. Frankly, the GST has come like a literal blessing. But let me
so that's what I'm saying. So globally, so the question was globally, is this kind of business model prevalent in the sense you would have these large, like a Foxconn equivalent in global parlance would be there for FMCG also?
So that is Foxconn equivalent, no, because the product categories do not allow for a product to be made in China and shipped all over the world. However, local contract manufacturers are definitely there. If you ask me a question of what we want to be when we grow up, there are a bunch of companies in the US, in Europe, who are not only doing contract manufacturing, but also doing contract research. So a lot of domain experts are there who will work only, let's say, in color cosmetics, or who will work only in the detergent segment. And not only will they do contract manufacturing, but they also develop new products, which the brand owners then adapt from that proprietary technology. So yes, this model is been around for a while. It's just that India, it's just beginning to take off. But at least for us, we think that it's beginning to take off.
Got it. And generally, just from a pipeline perspective, I'm assuming because you have to set up factories, the discussions would start 12 to 15 months ahead of time. So today, you would be into discussions for F22 and beyond for setting up factories, right, with your clients and customers. And I think that is the reason why you're bullish. I'm just trying to get some color.
Yes, absolutely. I mean, I can't answer that in any clear terms. Because obviously that's what we do for a living. So we continue talking to people, we continue pitching work to people, we continue negotiating projects with people, and as soon as they get signed, we take it to our board, and once they authorize it, we inform everyone.
And these projects, mostly when you are in discussion, just from a split perspective, is it in-source to outsource, or incremental growth being outsourced to you? In the sense that they are growing at 5%, but they need not set up factories on their own, but they are shifting that incremental 5% to you.
Currently, depending on the product category, it could be both. So let's say home and hygiene category, for instance, is growing at a disproportionate rate in the last 6 months, and a lot of discussions around that revolve around being able to cater to that growth. In case of certain other products, there's some amount of realignment of manufacturing footprint because of GST. In case of certain other product categories, it's basically insourcing to outsourcing because the tax exemptions in the various zones are being phased out.
Got it. And just from a longer term perspective, okay, I'll get back into the question.
If that is okay, because I really don't know.
Yeah. Please. Yeah. No problem, Sir. No problem. Yeah.
Thank you.
Okay.
The next question is from the line of Sandeep Sharma from Ambit Capital. Please go ahead.
Yeah, hi, Sameer. Hi. My question is very, straightforward and simple. The company, if we track the company, last 3-4 years has been dramatic for the company from a growth perspective. While the controlling stake acquisition in the listed company happened some time back, but the real growth has happened in the last 3-4 years. I wanted to just understand from your perspective what changed, say in FY18, since when you basically started the growth phase, and that is the momentum has continued both from a organic as well as inorganic growth perspective.
Okay, so Sandeep, well, actually, I don't think that's the case. What has happened is since we tied up in 2012-13, and I will have to look up the exact timelines, but it took us nearly a year to get all the things in place. We actually signed up contracts and did inorganic acquisitions right away. I think within the first year of the tie-up, we agreed to acquire one facility in Jammu from Reckitt Benckiser. We agreed to acquire the leather business of Unilever in the first year itself. In the next couple of years, we managed to set up new factories in Coimbatore as well as in other locations. What you have to appreciate is what I was talking to the previous person as well, that these discussions do take around 10 to 12 months in terms of actually coming on board. And even after they come on board in terms of ramping up, depending on the complexity of the factory, it takes us 3 to 6 months. And I guess that's the kind of time. So to answer your question in short, no, we have been working since 2012 and 13. It's not that we started working only in the last 3 or 4 years. The team has been at it for the last nearly 2 decades. What you're seeing now is frankly a culmination of all those efforts.
Okay. Just one more question along with this, that the expansion phase that is happening both in organic and organic, which has continued in the recent time. How do you see the growth coming up in the coming years, whether it will be more of organic or inorganic? And the second question linked to it is that you already raised some funds from some amount from 2 private equity funds. But how do you plan to fund the growth going ahead?
Okay. So from the organic, inorganic part of it, I really don't know how you're splicing it. For us, organic also means setting up greenfield projects, right? So when I talk about inorganic, I only talk about acquisitions. However, in case of some people, they look at setting up greenfield projects as inorganic, and they say when you have a same factory, what is the same factory growth? In our business model, frankly, the same factory growth is irrelevant. So for us, organic growth within the same factory is quite irrelevant. Most of our growth will come from setting up new factories, expansion of new factories, which is brownfield projects, greenfield projects, and maybe acquisitions. Going ahead in terms of acquisitions versus what we call the other avenues of growth, we believe that the other avenues of growth and acquisitions, I would say, would be equally contributing to the growth ahead. There is still a lot of potential in terms of consolidation in this industry, and we do believe that there's also a lot of potential for our principals to look at probably divesting some of their facilities and giving it out to a contract manufacturer.
Sure. Thanks, Anish. This is helpful.
Sure.
Thank you. The next question is from the line of Akash Zaveri from Perpetual Investment. Please go ahead.
Good evening, Mr. Kothari, and congratulations on a great set of numbers. Just one question that, since home and personal care products are a big part of our portfolio, does the company have any plans to backward integrate into oleochemicals or something like that?
Hi, Akash. Thank you very much. Akash, not currently. It's definitely a very interesting avenue for us. But currently, we believe that we have enough potential to grow in the business that we are currently doing. And you're absolutely right that at some point of time, that's a huge opportunity which we haven't tapped. And we will probably get to it, but now is not the time. And when I say now, I mean not for the next couple of years at least.
Yeah, that's great. And just another question. So you spoke about the private label business a couple of minutes back. So just wanted to know, as a percentage of the revenue, how big is it currently, and where would you see it going in the next, say, 3 to 5 years?
It is completely insignificant in terms of revenue size right now. However, from a strategic perspective, we are very keen and bullish on it because of all the right reasons, right? I mean, the growing e-commerce, the growing modernization of trade, of retail trade, the growing power of the Amazons and the Geos and the Flipkarts of the world. So we believe that it will become very, very large going ahead. Just to give you two examples, in Mr. Sanjeev Mehta's speech during his results, I think he mentioned that nearly 7% of HUL's sales now come from online portals. And I think that's a huge number, and it's a trend which I think everybody should sit up and watch. The second statement that I want to throw out to you again from DMart's CEO, who said that they would like to do a lot more private label, but they are not able to get enough credible and long-standing contract manufacturers. I think the two put together should give you an idea of what the potential for private labeling in India is.
Great. Yeah. Thank you so much. That helps a lot.
Thank you. The next question is from the line of Tushar Sarda from Athena Investment. Please go ahead.
Yeah, thank you for the opportunity. My question relates to, just having a little better understanding of your business. You mentioned that you're agnostic to the kind of industry or product. So what are your real strengths in terms of contract manufacturing that you bring to the table for the principal who gives you the business? Second is, what kind of technology or know-how they give you, because they would like product uniformity, right? If they're setting a branded product, they would want uniformity. So what kind of input, for example, do they procure raw materials for you, or you procure yourself? And what kind of supervision does the principal have?
Sure. So Tushar, right?
Yeah, that's right.
Okay. So Tushar, in terms of, again, some of this stuff I may not be able to discuss because of competitive reasons. So let me give you an example of a completely different industry. So if you look at electronics, right? If you look at an Apple and a Foxconn, so you would basically have a similar kind of a situation. You have the technology and the IP being developed by the marketing company or the brand owner, who would then pass on that to the contract manufacturer. And from a contract manufacturer's perspective, maintaining the quality, maintaining the price, maintaining the timely deliveries, and the integrity and the relationship of honesty that comes in is very, very important. So let me elaborate, right? So when Apple gives the technology to Foxconn that this is the phone that I want to assemble, Foxconn, it implicitly trusts Foxconn that it's not going to take this knowledge and go to a Samsung and say, I can make a similar phone for you. One, it also trusts Foxconn that it's not going to use this technology and make a phone owned by a brand owned by Foxconn and start selling it in the market. Three, it also trusts Foxconn to ensure that when it makes an Apple phone, the phone actually that Foxconn makes does not get leaked into the market, which means that all the phones that Foxconn makes goes back to Apple and then Apple sells them, not that Foxconn ships 100,000 phones separately to the black market and starts making money on it, right? Fourth, in terms of the contract manufacturing relationship, what is very important is that if you buy an Apple phone and if your Apple phone doesn't work, you're not going to look behind it and say that was this made by Foxconn or was it made by somebody else? You're going to be unhappy with Apple. So Apple is extremely bothered about the fact that Foxconn should not screw up on quality, should not screw up on the timeliness of the delivery, should not screw up on anything which can harm the brand value of Apple. And as a result, it maintains humongous amount of supervision, humongous amount of control over everything. But the fact of the matter is that the execution in the end is with Foxconn. That's my point throughout, even in my previous discussion with someone earlier, that just because someone has $1 billion, you can't go to Apple and say that, okay, I'm going to be the next Foxconn, because it's not just about setting up a factory. It's got to do about relations, it's got to do about trust, it's got to do about ability, it's got to do about execution. And I think that's what we bring to the table as well when we're talking to the principals. Does that answer your question?
Thank you. Yeah, it does. Thank you. It was a very elaborate and a very nice explanation. Just one additional follow-up to this. Foxconn has actually helped Apple develop a lot of technology, so to say. If you read the articles, for example, they wanted to put glass on the phone, so Foxconn played a very big role. I think it may be early days for you, but do you think you would have those kind of opportunity to help the principal in development of a product, maybe say development of packaging, if not the actual product, and those kind of things?
Yeah. So at a very basic level, that's what we do with private labeling. However, you're absolutely right that we are very, very early days in terms of being able to add value to our customers to that extent. And that goes back to what I discussed earlier, that at some point of time, we would like to emulate the guys in Europe and US who do contract research as well as contract manufacturing. And you're absolutely right that that's something which we want to do when we grow up, but it's too early days right now.
Okay. Thank you. Thank you for a very detailed answer. Really appreciate it, and all the best.
Thank you. Well, ladies and gentlemen, due to time constraint, we take the last question from the line of Vinod Malia from Union Mutual Fund. Please go ahead.
Yeah. Hi, this is Samir Kothari. I just have a couple of questions. So first on this, recently the government has announced that the PLI scheme for food processing industry. So just wanted to get your sense. How do you look at this, and if you can provide some kind of details about this, like any details in sort of what kind of capex which would be required for any player who want to take this incentive, and any sort of revenue target which they have to meet to get this incentive. And the second part related to this is that Hindustan Foods, I mean, you have been talking about looking at export opportunities. So does this PLI scheme will expedite that export opportunity, and how do you look after how are you exploring this opportunity?
Excellent question, Vinod. So Vinod, the PLI scheme has been announced. What has been done is basically an allocation of a certain amount of money has been made to the food processing industry. However, the details of the package have not been announced. In fact, the government is in the stage of consultation with the industry, and we are playing a small part in it as well, where they are asking which particular areas, which particular product categories, where they should be announcing this type of a scheme, how the scheme should be announced in terms of the delta sales that is expected, in terms of the value addition, etc. There is talk about the difference between food processing and agricultural processing, which means should we do it at the level of farm produce, or should we do it at the level of the factories where it is produced into processed foods. So there's a bunch of things which still need to be done. I would say it's a little premature to get into the talk about the PLI scheme for the food processing, unlike that for the electronics industry, where it's a little bit more clear-cut. In case of food processing, it's a very encouraging sign that the government has done it, but we'll still need to see what the final details are before I can actually comment on how it's going to change that. But we are very excited, and we are obviously working with the government to see how best we can leverage this.
Okay. And the second question was on your capex thing. So you have said that you would be investing 150 crores in the Hyderabad